So during any market, there are going to be winners and there are going to be losers. 2020 saw a lot of winners, many of them, in fact, most of them, being tech companies or companies that are playing like the cloud space, SaaS space, anything to do with enabling technology. Those companies did phenomenal last year. You know the names: Zoom, Shopify, DocuSign. These companies were winners. But simultaneously, when there's winners, there are going to be losers in the market. And last year we saw losers like, airlines, cruise lines, industrials. Those stocks didn't do too well last year. Now, one big sector that actually did pretty well last year, all things considered, was the consumer staples sector. And so far here in 2021, we're only about a month and a half in, this sector is starting to show us value as these stocks have pulled back recently. So yes, we're talking about these boring consumer staple companies today. And I got my boring old long sleeve dress shirt here, dressed like a boring old businessman to talk about these companies. But hey, if you are serious about investing and building up a good portfolio, these are companies you want to have some exposure to. Now, you can have a few of them, you can have a lot of them, that's completely up to you. But you definitely want to take some time to look at them. These companies add stability in your portfolio, so when the market swings wildly, these stocks kind of keep things in check. These companies also provide amazing dividends that keep growing over time. So even if the stock is flat for the year, for example, you'll still get some income from dividends, and they typically keep increasing those dividends too, which is a nice bonus. And the best part about these stocks is that regardless of the economy, regardless of whether we're in an issue like in 2020 or a regular recession or a housing crisis, people still need the products that these companies sell. People still want snacks, drinks, toilet paper. You need these things, and that's why these businesses just keep growing steadily over time. So consider hitting the like button down below. There's gonna be a ton of value in this video. Let's try to get 1,000 likes on this video, guys. And if you're new here, subscribe as well. And for those of you that don't know, I do have another channel, Positive Investing News, where I talk about more current events with relations to stocks and stock market. So you definitely want to check that out as well. Link description down below. Okay, so with these stocks, you typically want to have these in a retirement account. That's just my opinion. That's actually personally what I am doing. And you want to just have them sit there for like 20, 30 years, let them compound, let the dividends keep reinvesting. And over time, you're gonna build a massive retirement account with little to no effort. For example, say you have $10,000 invested in a stock, pick your favorite consumer staple stock. Say they pay a 3% dividend yield, which a lot of the ones we're discussing today do. And let's just say they grow that dividend by 7% annually. Very normal for these types of stocks. Also, what I added here was that the stock itself grows by 10% a year. This is what the average return is for the market, plus or minus 1% or 2%. So 10%, I think that's a fair estimate. Now, after 30 years, that $10,000 investment will grow to $317,000 if you have dividends reinvesting, or $205,000 if the dividends are not reinvested. Regardless of the option that you choose, the message is clear. Investing even a little bit of money today to let it grow over 20, 30 years in these safe blue chip companies will pay off massively and give you a very comfortable and, in some cases, luxurious retirement. Now, like I said, the reason I wanted to make this video today specifically and release it to you guys is because I am just about to fund my retirement account and purchase some of these stocks. I want to practice what I preach. I am building out my retirement portfolio, and I think over time, these stocks are just going to be ones that I just forget about, check back in 30 years, and that account will be massive. That's just a reality of the situation if you just consider the facts. Okay, so we're gonna get into the list now, and some of these names may have changed a couple of percent here and there because the market fluctuates on a daily basis, and it's very tough for me to film videos every single day when other current events come up that I need to talk about before this. So just bear with me, but in most cases, these stocks are around the prices we're going to be talking about today. So let's start off with the classic Coca-Cola, which is a Warren Buffett favorite. This name is down 17.5% and has found strong support on its 50 moving average on the monthly. This has been a very good level for Coca-Cola stock historically. We come down here Every so often, we kind of test this for a couple of months and then we rebound higher. This, in my opinion, is a buying opportunity right now in Coke. Coke pays out a 3.29% dividend, grows it by around 4.44% annually, and they've raised this dividend consecutively for 58 years. I am not worried about this changing anytime soon, despite the higher payout ratio that they have right now, because over time I expect this business to bounce back and stabilize. Now, another name I just want to add here also, which is starting to show some value, is Pepsi. This is kind of a twin to Coca-Cola and better in a lot of ways, in my opinion. That's another one worth looking into. Strong dividend growth, and good value. That is one that I personally actually own right now in my main portfolio as well. Clorox is another one here that I wanted to discuss because it's showing us a dip of 22% currently from its highs. This was a high flyer back in 2020, but has now come back to a more historical price level, and I think the value here is pretty good. It respects the 100 moving average on the weekly, which it has tested many times before and bounced off of. Now, like I said in my previous video, I think this may actually go a little bit lower here as it has had a big run in 2020, but regardless, prices now under 180 are starting to look really attractive for a position. Clorox pays a strong dividend, 2.34%, raising that dividend by 7.5% year over year, and it's approaching a dividend king status. It's right now sitting at 43 years straight growth. Rock solid company, and one that actually helped the world out tremendously in 2020, and I think their products are more loved now than ever before. KimberlyClark, who doesn't like toilet paper? This is an essential consumer product, and KimberlyClark provides that. The stock, however, has been going down the toilet in recent months, no pun intended, but has found some support on its 200 moving average on the weekly after correcting 20%. The stochastics at the bottom here show us that it's very oversold, so this is definitely a name to look at right now. A strong 3.5% yield in KimberlyClark is what you get today, 4% growth rate, and just about 50 years of straight dividend growth. And this just shows me, consistency consecutively every single year from a business that's been doing this for half a century. KimberlyClark, definitely one worth looking into just based on their rock solid history. Church & Dwight, this one is one you may have not have heard of before, but I bet you've heard of Arm & Hammer and OxyClean. These are brands that this company owns. This stock has corrected 17.5%, pretty good correction, and it has found some support here on the 50 moving average on the weekly. Now, historically, it has bounced a few times off of this level, but we have had good probability of testing the orange line, which is the 100 moving average, because to me that looks like an even stronger level of support. So while this 17% correction looks good to start your position in, I'd kind of watch this a bit closer and kind of average in if we go lower to around that mid 70 level, because that's, I think, where we could see a true bottom in this stock. Now, Church & Dwight isn't as, a long dividend payer as these previous companies we just talked about, but it's getting there. It has a 1.2% yield, it's growing by almost 7.5% year over year, and it has 21 straight years of dividend growth with only a 33% payout ratio, which means they have plenty of room to grow this for many, many years to come. Now, this company is not dirt cheap, but because of their attractive payout ratio and the ability to scale this dividend much more over a long period of time and kind of keep that 7.5% growth pretty consistent, on average that is, this is definitely one you kind of want to take a look at and see if exposure makes sense with. Procter Gamble is one of the fan favorites. It's kind of like the big dog here when it comes to consumer staples, and I had to include it. And while it may not be the best value today, I think it's, showing us some pretty decent probability here to come down to that 100 moving average and test it, which is around that low 120 level. Regardless, for a stable long-term giant, it shouldn't matter too much whether it's at 128 or 122. A difference of a few dollars here and there is a negligible long time over the span of 20-30 years for a stock like this. Now, this one is truly a dividend king. 64 years of growth, 2.45% starting yield, and a growth rate of 3.44% annually with a healthy payout ratio for lots more room to grow. Procter & Gamble is a staple. I kind of have it up there with Johnson & Johnson as one of the best businesses in the entire world when it comes to just how they're run, how they keep growing, how profitable they are. Really good company and definitely one for a dividend portfolio. Now Unilever is a foreign company, but I had to really throw it in here. It's down 16% and it is at a key support level which it tests every so often. This is still a very strong business and it's experiencing a healthy correction. So this is a perfect opportunity for those of you that want some international exposure in a safe and stable stock. Now I think Unilever can come down to that orange support. However, we did test that during March 2020. So I think we may actually see around this $55 price for a few weeks before returning back to its highs. Now here's the thing, while I want to include Unilever here today, because of the international exposure, it has probably the weakest history here when it comes to dividends. But like I said, just an option. So they kind of pay sporadic dividends the last few years of their payments, and while they keep paying a dividend, it isn't as predictable and stable as other names. So like I said, this may be worth looking into for a small position, but nothing more than that. Okay, so what's that, like 5-6 stocks we've talked about so far? You know what? You guys are sticking around here for this video. Clearly you're enjoying this. Let's do one more. McCormick. This is a popular spice company and this is at a 17% discount now. Strong brand name, strong stock performance, and a healthy correction after a monstrous 2020 run. It is an oversold stock and it does tend to come down to the 50 moving average on the weekly every year to test it. So this seems like a good level to start a position in. Now for the dividends, this one is looking pretty good. A 1.5% starting yield, lots of room to grow, and they've been raising it by 3.33% year over year for the last 34 years. So a very safe and predictable stock here. Definitely not a very exciting company. In fact, none of these are exciting companies. I would not say I get excited about owning any of these, but investing doesn't have to be exciting, it just has to be consistent and provide you the opportunity to grow your wealth over time, which is what I believe each and every one of these businesses will do over the next 20-30 years in a nice, comfortable retirement account where dividends keep compounding, keeps growing, does its thing, and then when you want the money eventually, you will have plenty of it with stocks like this. Now, this is not financial advice, it's just personally what I am doing with my dividend portfolio. I know a lot of you guys are gonna ask, well, why don't you just invest in growth stocks? That's something that's come up a lot in my Discord group as well. When I talk about dividend stocks and retirements, just invest in growth stocks, Nick, what are you doing? I think there's a place for both. My main portfolio that I manage regularly, keep putting money into, buying stocks regularly with, most of those companies are growth companies because those are companies I actually get excited about and want to put my money into. Teslas of the world, Facebooks, Beyond Meat, you get the idea. But when it comes to my retirement, I don't want to play any games there. I want to make sure these businesses are going to be around for a long time. And with the track records of these consumer staple companies, paying dividends for 50 plus years straight that they've been raising it, these tech companies are great, but I don't think they can compete on that level. I love what I see with these consumer staple stocks, and like I said, even a small investment today, few $1,000s, $10,000, $20,000 if you can, will grow quite significantly over time because of compounding, because of the dividends, and because they keep raising those dividends. Not to mention, you're also going to benefit from these stocks appreciating over time with their actual stock price, so it's kind of a win-win situation to me. Also, to rebuttal that whole growth stocks versus dividend stocks, guys, dividend stocks can also grow quite well. Some of my biggest winners from 2020 have been these boring companies. Nike, for example, it's a great dividend stock. It's up over 100% of my portfolio. So just goes to show you, just because it's a dividend stock does not mean it can show you massive capital growth over time as well. Just wanted to put that out there. Anyways, I don't think I missed any of the popular consumer staples here, but if I did, I'm sure you guys will let me know in the comments down below. Again, thank you for sticking around. Hit the like button, subscribe if you're new here, and check out the new channel if you want to see more regular videos from me. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one.